Hi, everyone. I'm Angela Princewill, and thanks for joining me today on this webinar where we'll be talking about determining income for child and spousal support purposes. So I'm going to try to keep this as short and quick as possible because this is a subject that it's a huge area and it could get very complicated. And so I'm going to deal with things on a very high level. If you have any questions, please let me know. And obviously, also after the fact, you can always reach out to us. Google us AP Lawyers, and our contact information is all there. Or send us an email, info@aplawyers.ca, or call us 905-492-7662, because I know that I'm just going to be addressing things on a very high level. And if you have more specific in-depth questions that you have, I'll be happy to deal with those after the fact. So anyway, where do we start? I mean, there's different types of incomes, the most common being employment income. And in determining income for child and spousal support, where you're dealing with a recipient that's a regular employee and doesn't have any other form of income, then it's a pretty straightforward sort of exercise, right? So you look at, what does their notice of assessment say and things like that. And, you take it from there. Things get a little bit more complicated when you have persons who have employment income in addition to, other kinds of incomes as well. So, it could be as simple as even a person drawing from their RSP, for example. That's additional income. I mean, that's an additional income source, right? That's separate from their regular income source. So I had a note here, actually. There's so many different sources of incomes, but I'm just going to reel out a few just to give us I guess, some kind of focus on our conversation. So there's RSP incomes, as I had mentioned, employment income, pensions, business owners, there's self-employed persons, there's, this old age income, CPP benefits, and there's government assistance programs in the form of either ODSP in Ontario or Ontario Works. And with all of these, there's the question of why does the income type matter? And there's a few reasons. So income type matters because, for one, the tax treatment of incomes are different. So a person earning employment income, for example, is different from the way they're taxed differently from a person that's earning capital gains, for example. A person earning dividend income is taxed at a different rate from a person that's getting employment income. So the income type matters when determining how child and spousal support would be paid, because it goes beyond, first, with a lower tax rate means there's more money that's available to pay child or spousal support. And so it just shows that you need to just go beyond looking at, well, what's the total amount of income and how much do they get to pay in support? Because the guidelines is kind of designed mostly for people with employment income. And in this case, I'm talking about the child support guidelines. So if a person has a different tax rate, then we might need to be a little bit more, maybe have to gross up their income a little bit more when having to decide how much would be appropriate for them to be paying as support. So even, I should also add, there's people that earn their incomes overseas. So if you're a foreign income earner, for example, then your income would not be treated the same way. For one, you could be taxed at a lower rate, and you could also be, and in some cases, you have a higher tax rate. So when the court is trying to determine incomes, first they look at the nature of the income that you have, besides, again, some difficulties I'm going to go into specifically in the context of things like business and self-employment income. So the first reason why income matters is because of the taxation rate. The other reason is there's a lot of room for creative accounting when you're dealing with certain income types. And by creative accounting, I mean deductions from income or deductions from gross revenue that might be appropriate under the Income Tax Act, but that reduce the amount of total income a person gets. And while that might be okay for, for tax planning purposes, when you're reducing the amount, available to pay child and spousal support, we need to look more closely, because as a society and well, in general, especially when it comes to child support, there's a desire to see that as much financial resources are available to care for the children. And so it's important that the total income is a true reflection of the resources available to a person to pay child and spousal support. And so if you're self-employed, for example, you may be allowed to write off things like, your vehicles, for example. You could also be able to write off, certain purchases, right? Certain personal expenses and meals and things like that. And while that's fine, it's usually taken off the top. So when you have a scenario like that, what happens is you're left with a lower amount of revenue on which to pay support. And it's really not an accurate reflection for the most part, because we have people that, maybe have revenues of upward of $1 million, but they have so much expenses that they could have less than $50,000 at the end. If those are legitimate business expenses, absolutely, there's nothing that can be done. Some businesses just, have a lot of expenses, and that's fine. But questions need to be asked so that if a lot of it is being used to fund personal lifestyle, then, we need to dig a little bit deeper. So that's the second reason why the income type matters. If it's just a straightforward, employment income, then it doesn't really leave a lot of room for creative accounting. Another reason is sort of the control that a person can have over their income, or their income amount, I should say. So if a person is the sole shareholder of a corporation, for example, they can set what their income would be. They have control over whether they take their income in the form of a dividend, or if they take the income in the form of just simple employment incomes, right? Again, remembering that dividend and employment income could attract different tax rates. So while the shareholder has a right to do that, again, for income tax purposes, we're here concerned about making sure that the proper amount is used in calculating support. So that sort of control over how much to be paid and in what form to take the revenue, and even for some people, at what point to get paid, right? Because could we be looking at a scenario where a person is timing their income so that kind of maybe watching to make sure that things clear up, maybe the family law matter is over before they receive more draws from the corporation and things like that, so that their income looks lower. There's different things people do. I know for a lot of people, the creative accounting and the taxation and things like that are done just from a CRA taxation perspective, and that's expected and that's fine. But, if a person has income that they have such control over how much, when, and in what form they get their income, then we need to, again, look a little bit further and investigate a little bit more in determining what their income actually is for support purposes. And the last reason why income matters is some incomes don't make it to the notice of assessments, right? Some incomes don't get declared at all. So in this case, I'm thinking some tips. A lot of people receive tips that they don't report to CRA, and that could be monies that's not being reported. And so how do we factor that in when we're trying to deal with support? And I'm going to talk about that in a minute. And then, of course, cash as well is a huge one. So many jobs and people get paid cash. And I mean, I'm distincting cash from tips here. Cash, I just mean straight out, people, not even just the tips, some people pay their barbers, their hairdressers, some mechanics, things like that. Even in some cases, people, pay cash to these, your graphic designer, for example, just so you get a deal and all of that. So those incomes a lot of times don't get reported. It's not easily accounted for, but they're income that should be, that are used in determining child and spousal support. So as we can see, when we, the amount, income matters, income type matters. And when trying to determine what amounts to use for child or spousal support, sometimes it's a straightforward exercise, right? If we have all of the income disclosure provided and all we need to do is gross it up for different tax treatments, that would be straightforward. But in a lot of cases, you don't have disclosure. So how do you deal with some of these issues, or what disclosure do you even request? So when you get a person's, or actually backtracking, when you're dealing with matters that have a child and spousal support consideration, you're required to exchange Forms 13 or Form 13.1, depending on whether there's property issues or not. So those are financial statements that are required by the courts. And even when parties are negotiating settlements, we sometimes use that to get a clear picture of everyone's financial position. So when you see the Form 13, you're required to attach your notices of assessments and income tax returns. So with the notice of assessment is not as comprehensive and doesn't give a lot. And I'm actually going to try to see if I can pull up, a notice of assessment here that might help give us better context as I speak. So give me a second here. Okay. Okay. Okay, so this is, so when you get the notice of assessment, which people would usually receive back from the CRA after their taxes are filed, and you're also supposed to receive this income tax and benefit returns, which is usually what is completed and sent into CRA for you to get your notice of assessment. It's important that you get this document because it helps give a fuller picture of the various sources of income a person has, and what kind of creativity has gone into their income. And this is a starting point for you to know if you need to dig deeper or not. So all here is kind of like basic information, social insurance number, names, things like that, marital status, all of that's on this first page. And then if you scroll further, at this stage is where we talk about the total income. So the total on this page, line 150, is what the guidelines, well, it's now line 15,000. It just used to be line 150. But, the line 1,500 now, which Sherry just changed, is where we get the total income. But the details here kind of give you, provide a guide. So if it's employment income only that a person has, that gets inserted there. And then you kind of see the differences, right? So even under the employment income, you would see what portion of that is commissions. Is there wage loss replacement, for example? And then as we go further, we see, okay, rental income. Well, there's net partnership income. So if you notice here, it says net partnership income. So that's not the full amount the partnership got. So, if there's income reported there, then you might want to do a little bit more digging to see what was the gross amount received. But yeah, a person's interest and investments income should come here. And then the rental income. So it's not unusual to see a person having gross rental income of $50,000 and netting only $5,000. It might be accurate or it may not, but it just means that that's an indication that, you know, you need to ask some questions there. In most cases, people with rental income would be carrying a mortgage as well. So it goes to reason that some of the rental income went to paying off a mortgage. For example, there might be property taxes and other legitimate, you know, repairs and things like that. But it's also not unusual for people to write off a lot against their rental income. So if there's an issue between the amounts of the gross and net, and it looks unreasonable, or, you know, if the recipient is saying, no, this is not accurate, this is a new build, this is, you know, this home is mortgage free, why is the net amount so low? Then you need further disclosure. The person needs to provide a breakdown of all of the expenses, and it usually would form part of this package of documents. So obviously I have a blank form, not fully completed, so there's no additional information on, you know, the various sources. But if the person had rental income you would be able to see additional pages that would show you, you know, just how much what the expenses are, what they are, and then you can have a conversation from there going forward on what's appropriate or not. Taxable capital gains. So when you see taxable capital gains here as well, it shows if there's an amount here, then it shows you that a person had capital gains income. And the reason why it says taxable is for some capital gains, there's a portion of it that's non-taxable, right? So in some cases, only 50% of capital gains is taxable. So if a person's reporting $50,000 on their income tax returns, it may mean that there's, you know, the amount made was $100,000. And for child support purposes, the actual income is the $100,000, not the 50% or $50,000 in our example that's being reported on the income tax returns. So now you need to flip through and look at the other pages that gives you the actual amount. And this one's a pretty simple one. So if you're, you know, trying to determine how much is the total income, you just need to gross that up to the full amount of the actual capital gains. Support payments received, and that's, you know, those are clear enough. There's a taxable amount, and I'm just going to come down here to self-employment income because this is a major one. You know, business income, what's the gross and net amount, and, you know, if it's a professional, it shows that as well. So what's important about this again is if you're seeing a high gross income and a small net amount, you need to go back and look at, okay, what are the expenses that are being written off? When looking at expenses that are being written off, I guess the main guiding principle is reasonableness. So what's reasonable? What portion of these expenses were actually used for the business? If any portion of those expenses that are really just funding the personal lifestyle of the business owner need to be added back into their income for support purposes. So let's say in this example, we see here, I don't know, business income of 200,000, and then we see a net of $20,000. There will be additional, you know, information attached as part of this income tax returns where there will be a breakdown. And I'm going to see here as well, I'm going to just stop sharing this screen for a minute and see if I can find something else that gives us a little bit more of a breakdown on what some of these business expenses could be. Okay. Share screen, there it is. Okay, So here's a statement. I don't know if everyone can see my screen now, but this is what's called a statement of business and professional activities. So if it's a business that's a sole proprietorship, there will, this is required as part of the income tax filings. It's also required under the law, and as part of the family law rules, you're required to attach this to your financial statement so that the other side can get a clearer picture of your income. So with the statement of when you've seen that there's this what the gross income is, and now you're trying to figure out how did the payor get to the net amount. It should be answered for sole proprietors on this sheet. And again, here they will have to report the gross sales amount. They would be able to deduct whatever HST they collected, because a portion of their gross revenue is probably HST. So they have to, that would be reported there. And then if it's a business that sells, products, you would see information on inventory and purchases during the year and things like that. Now, if there were also subcontractors employed in the business, it would be shown here. On this page as well, you can see the different categories of expenses that will go towards reducing that gross income amount. So, and this is where common sense will kind of prevail. And the interesting thing is a lot of times, the recipient or the other spouse would usually have an idea, or even with common sense. So even for the lawyer or, for self-represented parties, when thinking about this, if a person is a sole proprietor, has a contract with, just one company to provide them with consulting services, and you're seeing, $50,000 in advertising expense here, you want to ask a lot of questions, because it's also not reasonable, to have such a high advertising expense when you're a consultant for one company. As we all know, there's people that choose to work as contractors, and so they're self-employed, they're business people, they get the benefit of these write-offs. But when we're digging deeper to determine what the proper amount is for them to pay child and spousal support, we understand that, okay, the nature of the business makes a huge difference. Meals and entertainment, again, a person who has a contract with, that's just a consultant for one company, having a huge meals and entertainment budget might be a red flag to ask more questions. But if you contrast that with a person that's running an advertising firm, for example, and has to take clients out or potential clients, to multiple dinners and events and things like that, it might justify a large meals and entertainment budget. And so you kind of go down the list that way, putting in mind the nature of the business, how reasonable is it? And maybe sometimes impute from the other side as well, saying, well, no, if the person has office expenses that are ridiculous, the person can say, no, there's actually no office, there's no rent being paid. This business, has been running for years and we run it out of our garage. So why is she or him putting in $50,000 in rent? It's not true. And so you kind of go down the list that way, request additional information where you can, and, apply sort of that test. But we all know that sometimes you could do all of this and you will come to the conclusion that these expenses aren't reasonable, that the expenses included here for the business person, or for the sole proprietor in this case, is overinflated. At that point, what do? That's when we have to resort to the one tool we have, which is imputing the income back. Under the guidelines, the court has, the ability to impute income under various circumstances. And this would be an appropriate case of, saying, we recognize that for CRA purposes, you've made all of these deductions, but we're going to impute, these incomes back to you. So when we're looking at the income tax return here, and a person has 200,000 as gross business income, but 20,000 as the net amount, while that might end up being their total income, we can say, well, even based on lifestyle, this person might be spending more than 20,000. Based on these expenses, they're clearly inflated. And, by applying common sense and reviewing the disclosure provided, if it appears that, okay, an appropriate amount of expenses is, say, $150,000, then that's what would be imputed as that party's income in these circumstances. So that's the income tax return and the statement of business and professional activities, which is generally for self-employed persons. But what if we're dealing with an owner that has a corporation? So I'm going to stop my share again and try to open a financial statement that's for a business. So if everyone can see the new document that I have up, this is a corporate financial statement. And if a person has a corporation, you really need to be looking at this. So for most sole proprietors, their income would generally be the net amount after they've deducted sort of their expenses from the business. But for corporations, there would be two sets of books. So because the corporation is its own separate entity, so you would have the corporate income tax returns and the owner/shareholders income tax returns. Every once in a while, there would be there'll be payors that would argue that they have no control over the corporation, for example, and that they just want to keep the corporation separate. So in those cases, you need to request the income tax returns of that person. The articles of incorporation, of that person, because the articles of incorporation would show you who the shareholders are and what their, how much shares they have. So in this scenario, I'm going to be dealing with, an owner, someone that owns about 100% of the shares, or someone that's a majority shareholder and has, control over how the corporation runs. So now looking at this, so this is, again, you notice this is a draft and it says notice to reader. A lot of financial statements that you receive from smaller corporations would be notice to reader financial statements, and that's fine. The reason the courts recognize that actually having fully audited financial statements is very expensive, and sometimes the cost isn't worth the benefit for a lot of smaller corporations. So it's okay to accept a notice to reader financial statement for the most part. So looking at this example, this is a professional corporation. So again, this tells me I'm not likely looking at a business. I'm more likely looking at a service business. Obviously, if you don't understand what business the company is doing, the articles of incorporation that I mentioned earlier would also tell you what the business does. But so if you look in this case, the cash position of the corporation is stated here. How much they have in investments and, plants and things like that. But that's all well and good. It doesn't matter much to you when you're trying to determine what the actual income for child or spousal support is. So this again is their liabilities. I only sometimes look at the liabilities page when I pay more attention if I look at the due to share, just to see the due to shareholder, or if there's a shareholder loan, for example. So if there's a shareholder loan, most times it would appear under the current assets because it's money that's so an advance to, if you see here, there's advances to shareholders. And in that case, again, without trying to keep this on a high level as much as possible, if you see that, you might need to ask more questions, because what could happen is when a person owns a corporation, rather than drawing money as employment income or dividends, they can choose to take it as loans. And so if they're taking it as loans, it doesn't get reported on their income tax returns, and that ultimately leads to less money being reported and available for paying support. So we go through the liabilities. Another thing I look at here is sort of retained earnings. I would see a little bit more about that down later. Retained earnings matter because if there's monies being retained, then it tells me that all of the funds that are being made by this corporation is not being drawn. And so the question that really raises are there legitimate reasons why these funds are being retained in the corporation? If it's necessary for viable business operations and things like that, absolutely, that's all well and good. But if it's just there for maybe taxation purposes, for example, because again, the corporation would pay tax at a lower rate than employment income would be. So if it's for financial purposes like that, then while that might be good, it would be necessary for us to impute that income to the payer so that we have them paying support on the proper amount. And okay, so in this is an interesting page, for example, because you can see that, net income for the year that's been retained, 352,000, and there's less dividends. So the dividends are the amount that were paid out. So dividend is money that's paid out to owners of a corporation. So in this case, it's $55,000. So assuming this is one owner type of corporation, you can see that they made, there's 352,000 this year, there's 446,000 and some hundreds the other year, and they're only drawing 55,000 in dividends. So for tax planning or financial planning purposes, this payer has decided that $55,000 is all they need to fund their lifestyle. So they would only draw 55,000. And notice it's also not being drawn as employment income, it's being drawn here as dividends. So first it's attracting lower taxes. And secondly, it's such a small percentage of the income made. So if we only go by the tax returns of this owner, then basing support on 55,000 is by no stretch going to be appropriate, right? It might also mean by drawing such a small amount as well. The other question it should raise is, well, is the lifestyle and personal expenses of this owner being funded from the business? Because if all of the expenses are being paid, then it makes it, then you don't need to draw a lot of dividends. And so, it works out for them financially, but not for the support recipient, obviously. So another detailed page where we get the full revenue for the year, and now you get the operating expenses. And so you would usually get, and I hope you guys can still hear me. For some reason, there's construction happening behind me. I hope it's not muffling my voice too much. But this is sort of, the equivalent of what we looked at on the statement of business and professional activities. This gives you all of the operating expenses. Okay. Oh, thanks, Anissa. She can hear me perfectly, so that's great. So the operating expenses, management salaries. Again, if this is a one-person corporation, then you want to know who is management salaries being paid to. There's a $6,000 for a subcontract. Well, most subcontractors get issued, some kind of year-end tax documentation. Are those available? Can we see maybe copies of checks to confirm this? There's professional fees and dues and subscriptions. Well, are these correct? And then entertainment expenses, depending on the nature of the business, as I said earlier, then you want to find out, is this appropriate or is it not? But you have to ask that question. And then there's amortization. And amortization is an interesting one because it's really not an expense in its truest sense. So this is, in a lot of cases, it's just the person being able to, or a business, I should say, being able to write off an expense they've already made against, it could be any number of things. It could be equipment, it could be whatever it is. And now they get to amortize it over time. And well, so going all down the list, I mean, in this case, bank and interest charges don't seem to be very high. That's fantastic. And so when you look at all of this, in this case, the expenses, are $68,000. If you're satisfied with the expenses, then the conversation can center around using maybe the net income here. So the net income before taxes, which is $401,000, could be a starting point as the income to be used for calculating support. Remember, again, when looked at the previous page, this support payer only actually drew $55,000 income from this corporation. It's their choice, but that's by no stretch the appropriate income to be used in calculating support, right? So as you can see from here, at the very least, even after taxes for the corporation, there's that $352,000. So at the very least, that's where the conversation should start, assuming that we're okay with all of the operating expenses and the taxes, the tax rate, everything is accurate. So you see why income types matter. And again, so let's say in this example, management salary is being paid to a new partner, for example, that doesn't work in a corporation. Then it's appropriate to write this $27,000 back in as income to the payor. If the subcontractor fee is being paid to, a friend that's not really providing any service, that amount needs to be written back in, added back in, so that the payor's income is grossed up for support purposes. So those are, that's why income type matters, because if a person has just employment income, for example, they don't get the benefit of writing all of these expenses off. So we need to, so the point of the exercise is to make sure that only actual business expenses get deducted from the business. And then we take the amount that's the actual net amount, and it's on that amount that we base the support that, that support payor has to pay. So, I mean, I'm going to try to hang it up here because it could get more interesting as we talk more about even, go further in depth into rental income and things like that. So the only thing I would add as well in determining income is there's times where there's payors that are overseas. And I think I mentioned this earlier. So if a person is living overseas and they have an unusually high tax rate, it's appropriate in those circumstances to maybe reduce their gross income a little bit. So I'm not even talking people overseas as business owners. I'm talking about straight out employment income. If a person, as I said earlier, if a person is in Canada, only has employment income, all we look at is total income, usually line 15,000, and that's it. That's all you have to look at. However, if a person is employed in a foreign country, besides having to, obviously change their foreign income to the Canadian dollar equivalent, it's also important to look at what their taxes are. If they have a lower tax, if they're paying a lower tax rate than they ordinarily would in Ontario, then in those cases, it's appropriate to gross it up to account for that. And so that's the lower tax rate, the higher tax rate. Another thing I want to point out there is sometimes people would raise the question of, is this the cost of living in those overseas countries? And while that's something that could really form part of negotiated conversation, it's not really required under the guidelines. Okay, I just see a chat here, so I'll look at that very quickly. What percentage does the spouse get when the income is determined for child and spousal support? Okay, so Zara, I'm not sure I understand this question, but it's not really looked at in terms of percentages. Child and what percentage does the spouse get? So I'm not really sure I understand this question, but I can, on a general note, I can say it's not calculated based on percentages. Child support, we have the guidelines. And so child support is determined based on the guidelines. Parties are free to determine to go off the guidelines, but it needs to be clear that reasonable arrangements are being made for that child. You can also stray away from the guideline. Well, the guidelines actually has a cap of about 150,000. So for those earning income higher than that amount, there can be some room for negotiation, I guess. Spousal support, on the other hand, there's threshold factors that one needs to meet. First, is the person entitled? What's the basis of entitlement? Then we begin to talk about what range does it fall in. And yeah, when you do calculate child and spousal support, ultimately, we would get to an amount that would show the net disposable income that's available to both parties. But that's, and in some cases, you know, if you're talking about a marriage where there's young children, for example, and there's shared parenting arrangements, or, you know, even long-term marriages and things like that, it might be appropriate to look at the incomes and say, okay, we want to do a 50-50 split, but it doesn't necessarily always work that way. Zara, I think I see you coming out of video. Did you want to give me some more context on?
Hi, thank you so much for taking the time to answer my question. Yeah. So I guess my question was, once income is determined, this is the income of the spouse, and it's, you know, well over the 150 cap on the child support tables. Okay. I'm questioning, what is the percentage that the spouse gets of that income? Is it like 50% when they have like 2 young children?
Okay, so if it's just if it's just for child support, I would say if you go on the Government of Ontario, Canada website, and they have the child support table lookup. If you use that, oh, my internet connection is unstable. Oh, okay, better. So if you go on the Government of Canada website and you use their child support table lookup feature, enter the person's full income, and whatever amount you get, well, you have to enter the number of children. You would also have to enter the province. Whatever amount that gives you, more often than not, is what a court would use. Even though the guidelines kind of, you know, says up until 150, most times for incomes way over 150,000, the courts would still go with a standardized table amount. For spousal support now, that would be a little bit more engaging. So the lawyers and the judges, we're all spoiled. We don't do the math ourselves. We all use divorce mate calculations. So when we enter the numbers into divorce mate, it gives us the child support amount, which is fixed. Then it would give us amounts for spousal support in the low range, the mid range, and the high range. Then we begin to, and those numbers, it would usually have a percentage or something at that point, but then we begin to have a conversation with what's appropriate here, where should it fall? If we're looking at, you know, a marriage where there's, you know, no children, very short marriage, no real dependency, then there's a tendency towards the lower end. But if you're talking about, you know, maybe a longer term marriage, things like that, and or even where there's children, even if it's a short marriage and there's children, then we start to look towards the higher end. With the children, okay. Yeah, with the children as well, there will be different, the percentages will differ depending on what parenting arrangement you have. So if the recipient has the children majority of the time, it's not unusual for
full-time, yeah. Full-time.
Yeah, so it's not unusual that in those cases for the recipient to even get a higher percentage of the net family income. So in this case, it's not just, you know, a percentage of the payor's income, it's both incomes. So the net disposable incomes of the family is what's looked at. Not just the payor. So where you know, the one party has the children full-time, then it might be appropriate for that person to even have 60% of the incomes, the family income, for example, because they obviously have more responsibilities. But there's also times where it's a shorter marriage and the parents, there's children that are being split equally, and the higher paying party feels like, okay, I want to pay less. I don't want to, but we're saying if there's a split parenting arrangement, it doesn't matter the length of your marriage, 50-50 parenting, we want to start around a 50-50 split of your net disposable incomes. Okay. So there's a lot of
thank you.
specific things that go into that, Zara. I hope that helped a little bit, but everyone's
It definitely helped.
different. It did? Okay. I'm happy to hear that.
No, like the answers to your questions and just the information that you were giving about income determination, that's really helpful. And it's really high level. That's what I was looking for. So thank you very much for that information.
Oh, thanks, Zara. I appreciate that. Okay, so I see a question from Andrea. Andrea says, if the payor only received SERB, do they pay child support and arrears based on that income? Okay, child support. Yeah, I know things like SERB, and there's a number of programs that have come out since 2020. Yeah, SERB is income for calculating child and spousal support. I pause because if a person's income is annual income is less than $12,000, then they don't pay child support. For spousal support, if the income is less than $20,000, they don't have to pay that spousal support. So that's why I pause. I have a feeling that even if a person received SERB for the year, their income, because I think it was $1,400, $1,500. Don't quote me on this. I don't remember what it was. I know it's recently, it's dropped over time. But if a person's SERB income is more than $12,000, then yes, they have to pay child support on that. What happened for a lot of people, with the exception of, I guess, some people in, I don't know, the gym industry and things like that have been almost completely battered. But for a lot of people, they received a combination of SERB income and maybe employment income or business income, things like that. So yes, you would include whatever other income they got and the SERB, because yes, SERB is income on which child support should be paid. So I hope that answers the question. Oh, and there's the part about arrears. So yes, when calculating arrears, for child support, generally the child support amounts change on an annual basis. That's the general rule. There's exceptions sometimes, but as a general rule, it changes on an annual basis. So in this case, and for most people, they pay income, I guess, based on the previous year's income. So in 2020, it might be calculated based on 2019 income. Or if you even want to be very articulate, well, whatever the income was in 2019 is what arrears would be calculated on. For 2020, it's also what would calculate 2020 child support payments based on the arrears that were, based on the amount that the person should have paid. So if 2020 turns out that it's mostly SERB income and it's $15,000 in SERB income, then that's the amount that would be used to calculate child support for that year and going forward in that way. So yes, it's not, a person doesn't get to exclude SERB from their income for calculating support purposes. It would only matter if the amount that they got as income for the year is so low that they're below the level where they're required to pay child support. Okay, all right. Oh, Andrea, I see you said that answered your question. So I don't see any other questions on the chat, and I don't want to keep anyone here too long. So I guess that would be it for today. If you do have questions, please feel free to email us, and enjoy the rest of your day, and do take care. Thanks for joining in. Take care, guys.
Thanks for your time. Bye.
Thank you. Bye.
Thank you. Bye.
Bye. Bye, guys.